Okay, so should you be a debt or an equity real estate investor, right? There are debt funds that are out there, they're becoming popular. What that means is you typically have more of a fixed rate type of return, typically 8 to 12%. Sometimes they're offered as equity, but they sit higher than the common equity. But I want to share kind of the differences between being a debt and equity investor in real estate, how it's a safer position. Typically, it doesn't have, again, as high returns, but it does allow you to have a little more stability. So let's jump in and talk about it. We're going to go over in 4 steps and have a quote at the end. I think you're going to enjoy this one. All right, my name is Bronson Hill. I'm the CEO of Bronson Equity. We've got $200 million in multifamily assets just like that. We're also doing ATM machines and car washes and oil and gas deals to provide consistent cash flow to investors. So we offer some diversity of stuff that really allows for investors to have diversity in their portfolio. So the first thing is the advantages of debt investing, right? What are the advantages? Why would somebody be a debt investor? Well, let's talk about what debt investing really is, right? So if you have a deal, typically it's made up of different parts. Let's say you have a multifamily deal. Let's say somewhere between 50 and 80% of that will be a loan, or there'll be a lender involved, right? So the lender is actually a debt investor. And I don't really think of it this way, but this is kind of how it works, where a family office or some sort of large fund will invest. And why would they do that? Like, what is the return for them, right? What's the reason they want to do it? Well, there's some advantages of doing this, right? Because when they invest, they are either the first or the second position, and they are the safest position in the deal. So if the price of the value of the property crashes, the lender will get paid, right? The lender will get their money back, hopefully some or all of the money back, but it basically provides some protection that they are in the first or safest position. So an advantage of it is typically lenders or debt investors. So again, I'm going to use lenders and debt investors in the same thing, because that's really what you are when you invest in a debt fund. And maybe the debt fund, they go buy real estate, and you have an asset that backs that debt. It's the same that happens as a lender that has a mortgage on a large multifamily property. So the first thing is there's steady payments, right? Again, the payments may be lower, it may be 8 to 12%, 7%, whatever the amount is, but there's a steady payment stream that comes in there. There's actually lower risk because of the collateral, and because you're sitting in the first or second position, there is lower risk. The third thing is that there's stability. It's less affected by downturns. Again, the reason why it's less affected by downturns is because if the property drops by 10, 20, 30%, typically there's enough equity in there that you're protected. So if the property is sold, the lender gets their money back. The second thing is the disadvantages of being a debt investor. So there's some disadvantages, right? It's not all clouds in the sky and roses, right? There's pluses and minuses to everything. So there's limited upside. So equity investors typically get some cash flow, and then they get some appreciation, right? So there's some sense where they're kind of riding out, they're sharing in the upside. Debt investors don't. They don't typically share in the upside. So that's a disadvantage. There's market-dependent returns based on the interest rates. So if the interest rates are super low, typically the debt funds will return less money because they're getting paid less. And the third thing is there's less control. There's less ability to make decisions on buying and selling or any sort of operational things, whereas equity investors may have some ability to vote or be involved in those decisions. So next is, what are the advantages of being an equity investor, right? Because we're comparing a debt investing versus equity investing. Well, as an equity investor, the potential for returns are higher, right? So you get typically some cash flow along the way. You'll get some of the upside where there's appreciation at the sale, things like that. Well, that's stuff that debt investors don't get, right? So you're taking the risk to be involved in the deal so that you can share in that upside. The second thing really is you can really have more portfolio diversification. So typically you can invest in many different types of assets, many different types of deals, even different classes of assets. You can put some money here, some there. It's a little easier to do as an equity investor, I would say. The third thing is the control and decision making. Sometimes there's an opportunity where you can vote on, hey, should we sell? Should we buy? What should we do in this particular thing, and be able to influence the management team in that particular deal. So those are some advantages. The disadvantages of being an equity investor is, there's a higher risk, especially in downturns. So what happens if the property value comes down? We're seeing this in multifamily where some valuations are down. The first person to get hurt in that is the equity investor, right? If the value goes down, if there's not the money to pay back the equity investor, that's just considered a loss, right? And so the equity investor will typically be second or third or kind of further down that path to where it's only if there is upside they will get paid. The second thing really is it is more capital intensive, so it requires more capital to invest. Sometimes it can, sometimes with debt you can get in and out. Sometimes there's funds, there's things that do it. But it can be obviously capital intensive. And then the last thing is the lack of regular income potentially. That maybe there's no cash flow. The cash flow goes away or the cash flow is reduced. And so versus a debt investor could be getting cash flow basically from day one, just about they start getting paid almost immediately, right? So debt and equity, there's two different routes. I'm not saying you should do one or the other, but it's just important to know kind of what the risks are, what the benefits are, where you sit in the stack. And so a stack is just, when you stack it all up together, who gets paid first, who gets paid second, who gets paid third. And it's important to know that because even if you have a higher upside, there may be times where you're like, hey, I really want to have preservation of capital. This is why I would invest in a debt fund, or I'd invest as a investor who's an equity investor, but they're a preferred equity, or they're kind of a different class where they sit above the common equity, right? It's a safer position as well. So it's not only whether it's debt or it's equity, it's just what position in the stack are you as you invest. So choose wisely. I'd love to hear any comments, thoughts that you have on this in the comments below. I want to share this quote with you. It says, "The rich rule over the poor, and the borrower is slave to the lender." So again, the borrower is slave to the lender. So the people that borrow, sometimes the equity can be a slave to the lender, right? The lender really is the one that has the most control in this. So just interesting to know. And again, that's something you can also have an application in personal finance as well. People that do really well, they can really be in a position where they can become the borrower. And I think it's also envious if you are the landlord, but it's also making sure you can manage that debt situation well. And the highest position, of course, would be the lender. So I want to share this video with you. This is about buying bonds. I think there's an opportunity now buying bonds. And we talk about debt investing. This is something that kind of falls into that. I did a video before the bond market had kind of crashed a couple of years ago. This one is saying, hey, there may be opportunity right now to jump into bonds. So check that video out. If you haven't joined our investment club, we're doing some things in multifamily, oil and gas, ATM machines, car washes, things that are cash flowing. We have some things that have no interest rate risk and that are just performing awesome. So if you haven't joined our investment club, you're not hearing about these great deals, check it out down below. Thanks again for joining. We look forward to seeing you on the next video.